Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
This is Jason Buck. I'm the CIO at Mutiny Fund, and it's my pleasure to have a conversation with Cem Karsan of Aegea Capital. He's the managing director there. Aegea goes back to 2011, but they're changing their name currently to Volatility Advisors. So we'll talk a little bit about the name change maybe. But Aegea, now Kai, is specialties in volatility arbitrage. So we're going to talk all things long convexity, long skew, and long vega. Don't worry, we'll also explain what those means. And for you diehards out there, we're definitely going to talk about Gary, Vanna, and Charm as well. But we tend to have a little bit of background to our investors and maybe the first seat or desk they worked in at maybe an institutional trading desk. But I want to start a little bit earlier with Cem. So let's actually start with Cem Karsan. What kind of name is Cem, and how do you pronounce a C as a J, and why does that happen?
Yeah, Turkish. So I grew up, both my parents are Turkish, but born in London, lived in Turkey as a child. Spent every summer there. All my cousins, everybody, grew up on the Mediterranean in the summers. But moved to Texas, and my dad was in the oil industry, PhD structural engineer, and kind of grew up going from Texas to Oklahoma to the parents eventually moved to Norway. So kind of lived all over the world as a kid. Was very fortunate. My parents moved to Norway when I was in late junior high, and I went to prep school on the East Coast to Andover, and was lucky enough to travel across Europe every summer. Really ski in the Alps in the winter, and hit the Mediterranean in the summer. So really blessed childhood. And really had an amazing experience there at Andover. Eventually went to Rice University, studied financial mathematics along with policy. Was always kind of on the edge of, debating whether to go do School of Foreign Service, right? Kind of study broad macro policy, or really go to the math quantitative side, which was always my other leaning, coming kind of from my structural engineer father. So, and I found the perfect mix of both worlds, ultimately, which is, broad equity index, quantitative volatility arbitrage, which really takes into consideration both volatility, both quantitative arbitrage as well as kind of broad macro views. So that's kind of what we do here.
So starting with your experience at Rice, you're either a dilettante or a polymath, but also are you a polyglot as well? How many languages do you speak in?
So Turkish, Spanish, and English. I spent a year in South America in college. Had lived in Spain for a summer prior, and really fell in love with a Chilean woman when I was down there. I was supposed to be down there for a semester. Ended up staying for over a year. That's a whole another story that we could talk about some other time. But amazing, amazing experience, and do speak a little bit of Norwegian here and there as well. As my parents lived there 5 years, and we spent a lot of time there.
Fantastic. So correct me if I'm wrong, but you got your first job trading in 99, and how did that come about?
Yeah, it actually started the summer of 98. Right on the tail of long-term capital is kind of where I got my first experience. That really kind of informed a lot of my kind of view of supply and demand and how powerful that was relative to kind of just statistical arbitrage. And, in 99, I started really full-time here in the pits in Chicago, and it was a different language. This was back in the day when we were still kind of arbing. That's my fifth language, I guess.
I was about to say, you got that hand sign. Yeah.
Yeah. I could give you the whole Arjun Septis, the whole thing. I could still do the whole thing. And so 99 started in there. Got to really moved into a important role at that firm that I was at, RBC Dominion Securities. Head of equity options really early, two years in, because the gentleman in front of me left and started a proprietary trading group here in Chicago called Belvedere. Trial by fire in 2000 was leading that group as we saw a major, obviously, decline during the tech bubble burst. And as we're prone to do, made a lot of money in the trading world, and looked at myself and said, look, I'm getting paid X, and I'm making the company many multiples of X, and thought I could do it on my own. So after about 4 years, I left and started a group for a specialist firm in New York called Bear Wagner Specialists, which is a division of Bear Stearns, that was looking to diversify away from their specialist business. John Mulhern, which is kind of an old famous Wall Street name, hired us to start the business for him. Built it out to almost 30 traders across the CBOE, CME, Board of Trade, Amex, P-Coast, and really built out a real presence. Unfortunately, their business, the specialist business, was even in greater decline than they expected, and we never got to the capital that we hoped to. And so I amicably left after several years. We had a good several years there, and took some gentlemen with me and started my own market making firm, which eventually was good timing because it was late 2016, right as kind of the vol markets really started kind of picking up. And from 2006, 2007, decade. I lost a decade there. So
yeah,
2000.
It happens. We're getting old.
Exactly. 2007, we really came into our own, became one of the biggest market making groups in there. And by 2008, we were up to 13% of the volume in the S&P 500, became one of the biggest market making groups in the indices. So took our, several $1 million investment and grew that to, many multiples. I won't put an exact number on it, but many multiples of that number. And enough so where I had, 99% of my net worth in the business in 2010 and decided it was a crazy run for me and really wanted to take a step back from market making and really start investing my own money separately and had an exit from that business and eventually started Aegea Capital in 2011.
So before we get back to Aegea, let's go back. So when you went from trader and decided to go out on your own, a lot of people make that transition, but a lot of people don't realize what's actually involved in running a business. It's definitely going different from being an employee to business owner. So, but you did it twice. So you must have had a good experience the first time, or you're a glutton for punishment, or how did you think about that transition?
I'm a glutton for punishment. No, I mean, candidly, I did very well economically. It's being an entrepreneur is, it's very different than just being a trader, and I had to be both. And I think I had a skill at both. I've been able to kind of bridge that divide. And there's a lot of things I really genuinely enjoy about running a business. There's the part about building things that really appeals to me. Teaching is a big thing. I love working with employees and whatnot to kind of build a better mousetrap and learning from other people. So yeah, I think those are the things that keep drawing me back to it, as opposed to just kind of going and running a major book for Citadel or some other, big group. This is kind of what we do, and it's I enjoy every single bit of it.
But after selling the market making firm, did you think about retiring for a while? Did you take some time off?
100%. The original plan was not to start a hedge fund. Actually, quite the contrary. I started managing my own capital on the side, really in a structured trade, and it was really kind of a long volatility trade that was meant to diversify my kind of long real estate and equity kind of positions. It's something that we used in the background of the market making operation that made us a ton of money in 2008 and 2009. And eventually, the X $1 million I had in there, which was very small relative to how scalable the strategy was. And the more I kind of coded up and built out the strategy, the more I kind of realized that there was an opportunity for other people to kind of join along. I had talked to a lot of friends about the strategy kind of in passing that were in the business. And, some people kind of encouraged me, wanted to co-invest and encouraged me to kind of bring on other investors. So that's kind of how it came to be. It was not meant to be a business initially. And about a year after starting that, and I took a break and traveled a bit, got married, had a child, and eventually, with child at home, I was started looking, I was thinking I'm not going to be a stay-at-home dad, that's for sure. So, as much as I love parenthood, I was ready to kind of start the next thing. And that's kind of how it came to be.
Well, it's always a great way to start a business when people are banging down your door to take their money. That's always an auspicious
a little bit
start.
Easier, yeah.
How did you think about volatility arbitrage or long volatility in relation to the real estate investments? I'm curious how you combine that book.
Yeah, so for me, it was always kind of a beta story. Particularly the strategy initiated was more to hedge a secular decline. It has some tail risk long volatility convexity to it, but a lot of the best parts about it is how it performs in a 2008 type scenario, where it's kind of or a 2000 type scenario, which is the environments that I kind of experienced, and so the idea was, if we ever got a secular several years of decline where illiquid assets like real estate would also decline in a meaningful way, that you'd have significant liquidity on this side to kind of to take and reinvest into kind of the real estate market or the equity market. And that's really the broad appeal here. It's not just the quick kind of mean reverting move that you get to kind of quickly cash out. It's really kind of month after month strategy that can pay major dividends and allow you to kind of buy in and when things are cheap.
Yeah, that was one of the impetuses for the Mutiny Fund, was exactly that, is coming from a background of commercial real estate development and going through GFC. I was like, there's got to be a hedge to have some a convex cash position, also have a liquid part of your book when your illiquid part of your book's taking that write down over extended periods of time. And it's a really interesting combination. So I was curious that I've never heard that part, that you were looking to hedge a bit of that out. And so in 2011, you started Aegea. What was the original thesis when you were starting? And I guess how has that kind of changed over time a little bit?
Yeah, so this strategy really started as a skew swap. It's not to your kind of average.
Explain skew swap. Yeah.
You're right. I was about to say, to your average investor, that's like a very kind of odd kind of thing that most people aren't familiar with. But as a vol trader, it's something that's very important. So if you think about it, you have kind of vol levels, like buying and selling vol, right? You have term structure, right? Which is, whether or not something on the term structure is too steep or flat, and whether you want to own something longer dated or shorter dated. You have skew, which really measures kind of the downside protection versus the upside protection. And people trade all of these things fairly liquidly, and they're pretty efficient. But one thing that we've discovered over time is that what's not efficient and has an incredible set of opportunities in it is the term structure of skew. So basically looking at skew at one expiration, maybe shorter dated, maybe a month out, versus maybe 2 months out, looking at skew and the relationship between the two in a statistical way. And there's an opportunity in that, especially in the equities and the indices, that has presented itself over time as a function of supply and demand. That creates a major structural opportunity. It's structural, so it's not something that's going to be arbed out of the market. It is a carry trade in essence, essentially similar to how VRP is. Volatility risk premium is a structural occurrence, and skew itself is a structural kind of carry trade. Skew swap is a much better risk-adjusted carry trade, because on a risk-adjusted basis, it's possible to get long volatility, the downside for a credit, essentially.
And when you say skew swap, though, are you structuring that in the listed markets? Are you buying that is that an OTC product?
So we're doing this in listed products. We believe, especially if you're going to be long volatility, doing it in OTC markets creates basis risk and a counterparty risk that essentially can be a major problem, as it would have been in March of this year, if you don't have if you don't have the liquidity of listed markets. So that's an important consideration for us. We've always wanted to be kind of primarily in listed markets. We do look at OTC. We do model a lot based on flows in OTC as well. But we like to be in as transparent markets as possible, especially during what can be illiquid times.
Yeah, I was just wondering if in 2011 it was different from now, that you were going a lot of OTC products and that's changed to more listed, or you basically been listed from the start.
No, we've been listed from the start. That's always been in our view, kind of you get a much better view of kind of the world that exists, and again, it's much more liquid. So our turnover is less than a week. So if you're kind of getting that kind of, if you need that kind of liquidity to kind of constantly rebalance the portfolio, you're better off in the most liquid products as well.
Got it. And then, so it sounds like, though, over kind of the history, I mean, everything obviously changes and evolves, but the general thesis hasn't changed that dramatically since 2011. Is that fair to say?
The framework and the thesis hasn't changed. What's changed considerably is our modeling of the opportunity set. We've just gotten a lot better at what we do, A, and B, in particular, not just finding what is the cheapest and most expensive specifically on the curve, whereas it started kind of actually as kind of a monthly structural trade that would rebalance. It's really moved to a trade that where we're pinpointing the exact peak of inefficiency. How we hedge that portfolio has dramatically changed as well. So kind of how we view our deltas, the distribution of potential outcomes. When we started, it was really kind of more of a simple Black-Scholes kind of approach to hedging the portfolio delta neutral. And what we've discovered over time is, obviously, I talk about this a lot on social media and whatnot, is there's a reflexive power to these positioning. So when something's high, that reflexively tends to mean that dealers are short that, and there's a likelihood for that to be a loser for dealers, or to move in the direction where it's not as profitable for dealers. So hedging and drawing our distributions has dramatically changed. And as we've gotten better, our rebalance time has come in considerably because there's a better opportunity set. So it allows us to pay a little bit more slippage if and when necessary to capture more edge on a regular basis. And so, so the tools, the knowledge base, the modeling has all dramatically improved. And the rebalance periods have also tightened. But the broad thesis is still the same. And and the beauty of this is a structural phenomenon that if anything is increasing over time because of more and more people in the marketplace needing to hedge in the market and also gaining interest in volatility products.
And I think we'll dive a little bit later into like the reflexivity and the dealer positioning and all that stuff. But at a high level, you have basically three core positions or three core ways you think about it. And that from that trading 30-day vol for the peak and range to sell, to dispersion, to VVIX. If you want to start maybe diving into how you look at it in three different trades or three different buckets, and maybe we can dive deeper into each one.
Yeah. So at the top level, there's this 30-day skew. It tends to represent relative to historic outcomes, right?
Can you define skew just for the people that may?
Yeah, sure.
Maybe we'll start there even. No worries.
Yeah. Skew is downside. When I say downside, out of the money to the downside in the market, right? It's the implied volatility that those options are priced on. And so that versus the at the money or out of the money calls to the upside. So the skewness is essentially a skewness of the distribution of the implied volatility of options. And so downside options are priced at a much higher implied volatility than at the money or even more out of the money calls. This is a function of two things. One, in reality, realized volatility historically is higher to the downside. So, there should be some skew, based on historical realized vol. That said, skew itself is, especially in the S&Ps, is structurally much higher than that realized volatility difference of downside moves versus upside moves. And that's just simply because the world is long. If you live, if you breathe, if you own a home, if you have a job, you're long. And insurance premium is going to be in the things that hedge that. That's essentially downside protection. And in terms of supply and demand, that means people are buying puts to protect themselves. Structurally, institutions are doing that, and they're selling calls. They're writing calls. Again, on the equity, on the index level at least, they're writing calls to pay for this downside protection or to create some type of yield and take off some of the potential upside. So these are both hedges to the portfolio. It creates a massive skewness to the distribution. The skew in the S&Ps is the highest historically in the world. And that's because, again, that supply and demand. This is where people come to hedge.
And then, so I interrupted you. You were starting to talk about 30-day skew and how you look at it out over 30 days.
So there's a heuristic. If you think about it, people, particularly portfolio managers, know that puts are overvalued historically, and that there's a vol premium that they have to pay. So they don't want to sink their money into long-term, historically, 1 year, 2 year, 3 year puts and just sit on them, because in general that tends to be a losing battle. They like to hedge dynamically. They hedge dynamically when they feel like it's an opportune time. And that has, even before the VIX existed, or we go back to the beginning of options, the peak of volume was always about 30 days out, about 1 month. That's a reporting period for most managers, obviously, and it's also a natural time to say, okay, I think this month, people don't want to go on 1 week protection. Historically, they want to, they don't want to own 2, 3, 4 month protection because it seems expensive. They'd rather go buy it dynamically when they want. And it's a self-reinforcing thing, because the more people there are trading 30-day, the more liquidity there is, the more, it's easy to come in and trade a bigger, hedge a bigger book where the liquidity exists. Because of that, there's historically a peak in skewness relative to kind of historic outcomes, and it's right before a decline in that skew occurs. Obviously, that skew goes to flat, to zero at expiration. So there's an opportunity there on a risk-adjusted basis to monetize that supply-demand imbalance and hedge that relative to other skew that exists in the marketplace. And so the strategy is essentially finding where skew is cheap behind that kind of 1 month, where it's cheap in front of it, structuring portfolios. And again, we do this with our own proprietary tools. It's a structured quantitative approach, but structuring a portfolio that essentially will take out this premium from the market and do it in a way that's actually long skew and long convexity, long units to the downside, while still being able to monetize a lot of that skew overvaluation as it comes into expiration.
How do you think about getting that ratio right when you're selling the rich and buying the cheap, but making sure you don't get your face ripped off if something unusual happens?
It's all about modeling and doing it. Having the way we model everything is we're not data mining. Obviously, I have 22 years of experience, and everything we did is informed by kind of a qualitative approach to understanding how the supply-demand dynamics work and what the potential distribution, potential outcomes are. So we really start with kind of a 3-layer approach. We take a distribution of market outcomes based on, this has grown over time, as I said, but it started really as based on the VIX bucket you're in, based on the market moves there are. We model kind of the distribution, how we have a sense of how fat those tails are. And then with the Vanna and Charm and these other effects that we talk about, we help kind of affect that distribution a little bit. So that's kind of level one, not starting with a log normal distribution, which is what kind of Black-Scholes would do. We have a much more kind of sophisticated view of kind of what the potential outcomes may be. Then we model implied volatility moves of at the money vol based on each potential market move. And again, this is based on kind of deep understanding analysis of kind of how different term structure at the money can move. This is the vol path. And then we're looking at skew and the potential outcomes for skew in a similar model. So we model all of these, then we go look at the actual surface of these products that we're trading. And we look at also what's high and what's low based on a very kind of smooth dynamic surface. And then so we look at where that is relative to current, and then we look at that also relative to historical outcomes. And we have a tool that essentially will run through the scenario, structure the portfolio with certain restrictions. So it has to be long vol, has to be long skew, has to have X% of winning and different, and different. Out of all the potential outcomes, percentage winning expected return, we look to an expected return over kind of a risk, several different risk metrics, and it brings us up to the optimal portfolios. We put that on, we rebalance as the expected return. The second something gets to a threshold where there's a better expected return. So it's really a quantitative approach. You said, how do we do it? We really trying to quantify everything that we do and really take a really quantitative algorithmic approach to putting these positions on and rebalancing.
How do you think about with a statistical arbitrage like that? How do you think about remaining, an arbitrage or market neutral versus being long skew or long vega in those scenarios? I'm just curious. A lot of people would just try to do the VIX arbitrage and just have that income stream, but it's different to be positioned in case of a spike event. And I'm curious how you think about that.
Yeah. So we kind of have two parts of the portfolio. You kind of alluded to this earlier. We're not just monetizing this kind of 30-day vol. you can do that and structure yourself kind of long vol. And that's the part that really works well in this kind of secular decline, right? Because you keep monetizing that 30-day as it goes away. The longer dated stuff you have moves up the curve, and you can kind of digest this month after month and really make a good return over an extended secular period. But there's also a different kind of move, which is really kind of this spike, kind of like March move, right? Which is really about owning the most convex products available, and that's where kind of the VIX kind of comes into the picture. Our view is really, as most people know, that if you're looking for real convexity, that vol, that those calls and VIX and whatnot are generally the most bang for your buck for a really convex move. And so we do add, when the opportunity is there in those types of products, we will add those for the convexity. If not, we're also just owning again, as long convexity, long units, long skew as part of our structural bias. We're always, modeling all of these potential outcomes. We're looking at not just a VAR, but really looking at extreme tail events and modeling those tails.
Yeah. So far we talked about the 30-day skew part of your book. About VVIX. Buying calls on the VIX. Another place you look at maybe opportunistically is dispersion. Can you talk about dispersion a little bit?
Yeah, so we look at dispersion and correlation quite a bit. Dispersion in particular is a great opportunity. This in particular is something that I think a lot of people haven't really until recently, and I've been talking about this quite a bit on social media, really zeroed in on. But this understanding that, as we saw in 2017, that when there's a reflexive pinning of markets that comes from when dealers are oversupplied on index implied volatility, and that's very often locally. They're often locally oversupplied. In 2017, we saw the lowest implied volatility of all times, and we also saw the lowest realized volatility in history. I mean, if you go back to 150 years of market history, by 30%, the lowest realized volatility in history. We also, what we saw through that period was that it was also the lowest correlation in history, and again by 20 to 25%, significant margin. And most people would have said, well, the low volatility was a result of the low correlation, because everybody kind of takes this equity view when they're starting with everything. And what we knew, being kind of as a market makers and as also understanding those markets intimately well, is that the index was ultimately what was pinning the market, the index, and eventually, and ultimately, if that index is pinned, you don't get rid of idiosyncratic risk. You still have earnings. You still have cures for diseases. You still have new technologies. You still have a stock going in one direction based on that idiosyncratic risk, which means if the index is pinned, that ultimately some other constituents have to go in an opposite direction. And so that understanding has informed really a robust kind of view of modeling when the opportunity set is particularly good for dispersion and being long names versus versus short index vol. And so when there's an opportunity for that can be very profitable and counter-correlated to long volatility trades. It's a very profitable trade when volatility is compressed and when long volatility isn't performing. So it's a nice diversifier to those types of portfolios, and then those opportunities can really give you some extra alpha.
So not to state the obvious, then, do you just, in a high vol environment, do you just stay away from dispersion trades, or do you think about it in a different way?
It's more nuanced than that. I mean, you would you could look at what the implied volatility environment we're in now, right? Which is really have this floor at around 20, which a lot of people would say, wow, that's high, right? But in this environment, despite volatility being on the tails, being very liquid and undersupplied, and skew being very high, and products like the VVIX and those tails being incredibly bid. Local volatility is actually very oversupplied to dealers. You really have a situation where at the money vol is broadly owned, and unless you can get beyond kind of this at the money kind of area where gamma is owned by the street, the market really has this mean reverting aspect. The indexes, dude. Meanwhile, it's a volatile period. There's a lot going on in terms of macro. Fiscal versus monetary rotation, a lot of crazy moves and kind of name stocks with all the retail demand, and so there's there's a lot of volatility going on underneath the surface because of the idiosyncratic risk is immutable to a great extent because there's not enough supply in those products. If anything, there's a lot of demand for the volatility in those because of like these retail products and whatnot. And so it really creates in this environment, we've seen an incredible opportunity for dispersion despite vol being quite high. So it's not just a function of where is that volatility. It's really understanding kind of dealer supply and demand. And that's something we do very well. I think being kind of, again, at that, coming from the belly of the beast and understanding how market makers, take on positions and the type of positions they have, and being able to model that has informed not only our distributions of how vol moves, but also how dispersion moves and when that's an opportunity.
So thinking about that, we talked about put skew earlier, and then like you said, with these single names, we're seeing a lot of call skew coming into the market. A classic dispersion trade is to sell a straddle on the index, buy a straddle or strangle on individual names. Do you think about just taking directional plays when you have call skew in individual names in a higher volatility environment?
We take a very statistical approach with this product. We have other funds that we are launching we're managing on a proprietary level that, and actually next quarter that we're going to be launching that really focus on the distribution of potential outcomes and taking more directional bets based on that. That is quite profitable, essentially modeling these distributions as part of our long volatility and vol neutral books really made us we've always known how valuable it was, but really kind of doing that, putting in that work for this really informed us on how profitable that was on its own. And those directional indicators do get integrated into the long vol distributions, like I said, and do provide a significant amount of edge in alpha here. But as a standalone, we really take directional bets in another product. That's not really the focus of our product here. It's really to model the best opportunity set for long volatility exposure.
Great. And so you've hinted at it many times with the dealer and the reflexivity of dealers. So I don't want to bury the lead too much. If people aren't obsessively following you on Twitter, can you kind of fill them in who Gary and Vanna are and how Gary charms Vanna, and just like kind of walk through kind of the higher order Greeks or how the reflexivity of dealer positioning happens?
Yeah, so Gary is, it's a long story. I won't get into the whole thing, but there were clerks on the floor, back in market making days that would, be asked to do several different bets, whether it was either 150 chicken McNuggets or something crazy, right? Make 100 free throws or whatever it was. And so as we learned over time, being in the pit, you usually don't bet against the guy who's being challenged to do these things, because the odds of them happening as outlandish as they may seem are much higher when somebody's incentivized to make sure that that guy's going to go practice 100 free throws. He's going to go eat 150 chicken McNuggets, make sure he can do it because he's getting some cut on that trade. And that idea is really, and that guy's name, that I've made up for, is Gary, that used to do this. And so my name for dealer positioning is essentially Gary. It's this, this, if the positioning is a certain way, it's more likely to affect the outcomes. It's not like tornado insurance, right? Tornado comes through town. The tornado, whether or not the tornado comes in town, does not affect the likelihood. The likelihood of the insurance and how it's priced is not based on whether or not a tornado has come through town or not. So the point here is ultimately, when dealer positioning is a certain way, you have to change your probabilities based on that positioning, because ultimately if everybody owns puts, the market's less likely to go down. If everybody's short puts, the market is more likely to explode and more likely to cause a problem, like we saw with XIV in 2018. So that's Gary. Long-winded way of saying dealer positioning affects the market. That's Gary. I talk about that quite a bit. That's kind of what I was talking about with the dispersion trade, right, and how important that is. Vanna and Charm are really a function of some of this dealer positioning, which is, broadly in the indexes, like I alluded to, skew is bid. Downside protection is what people own, and people sell upside, and that's a structural occurrence because, again, we're all long the market in one way or another. Because of that positioning, dealers are short put, long call. It's a structurally great trade. There's a lot of edge in it. It's a carry trade essentially, but it has a tail to it, just like all carry trades. And it's a massive carry trade, much like kind of borrow in yen and lend in lira is, right? And that massive structural carry trade leads to a short stock underlying position against being short put long call. That as that position expires and as those positions which we can track, the dealer kind of positioning comes into expiration, that as the volatility declines on that, as time passes, you can measure that Vanna, which is the change in implied volatility effect on delta, as well as that Charm, which is the change in day effect on delta. You can measure that and really see the effect of those flows and that dealer positioning on the market. So a deep understanding of that is really extra structural alpha and edge to understanding what the real distributions look like. We've been very good at predicting this stuff online, obviously. I think that's why we've gotten such a quick following in the 6 months since we started talking about it. But this stuff really informs a lot of our distributions and our directional understanding.
So thinking about this dealer positioning, obviously it can create an issue where things are pinned and you have a very mean reversionary environment. And then beyond a certain barrier point, you can have this reflexive breakout that can really exacerbate moves. But without getting the secret sauce, like a lot of times we get a lot of questions of like, how can retail traders, somebody follow this? Like, is there good metrics for measuring dealer positioning? I mean, outside of modeling your own models that you have from decades of being a market maker to talking to people on the street that you built relationships with, how do people get an idea of whether dealer positioning is in a mean reversionary environment or in a breakout environment?
Look, there's having experience.
That's a trick question. Is there a way?
Yeah, right. I have 23 years of experience and have the relationships from all the floor brokers, get all of the real-time information across these products. What a retail trader can do is they can take in the volume. They can look at open interest. They can, in theory, if they have the tools and understanding, they can model the volatility surfaces of these products. With those three things, they can kind of piece together some portion of the information that we look at, which is kind of what is the positioning of dealers, right? If something's really high on the volatility surface, that's likely to give you some insight into positioning, especially if you understand kind of the broad dynamics of why it's high and what trades are kind of causing it. But the key to do it at the highest of levels is really to understand, when those trades come in, who are those, what are those trades? Who are they? Are they hedged? Are they not hedged? What does that mean for the effect on dealers? Is this, again, understanding the full picture and understanding how the market makers are going to react and how they broadly hedge, what the dynamics are in terms of timing and of when they're going to need to rebalance those portfolios. I'd like to add, we talked about Vanna and Charm, but just as important, and this is kind of alluded to in that conversation about dispersion, is these dealer effects also really affect implied volatility. So they're really good predictors for not just the distribution of market outcomes, but distribution of implied volatility outcomes as well as skew. So if you have a certain calendar put spread on in the indices, and it's really cheap, you're likely to, as that decays, people are going to have to buy back stock. People are going to have to, dealers are going to have to sell the longer dated volatility. They're getting longer volatility as that passes. They're going to have to sell that. If the skew is, the skew is likely to also collapse. So between these three things, that trade, even though it looks great, may not end up being a very profitable trade. But if you knew kind of how the positioning was going to react, you could really monetize that by modeling the outcome better and hedging the delta properly, hedging the vol properly, and hedging the skew properly.
And you also have to have a good idea of where large institutional flows are coming from with non-economic hedgers and how that's going to affect skew and therefore implied volatility too, right?
Correct. So we not only look at listed products, like I said at the top of this conversation, we also look at structured products from banks. We're really trying to take in the whole universe. We're looking at not just indices. We're looking at single list names and the big orders coming across there, and how those are getting filtered across to the indices, and how that affects correlation, not just dispersion, and how that will ultimately likely affect the whole universe on different kinds of moves.
I think about it a lot like when you're running a fine dining restaurant, right? You build up these avatar profiles of the best food reviewers in the world, and so when people come in, you have the way they make the reservation. You start to get a glimpse or a hunch, and you start collating all these different data sets, and you go, this may be a Michelin star reviewer here, so I'm going to really pay attention to this table. Is that kind of the way you look at like that order flow? If somebody's constantly 10,000 lots here or there, that's likely Bridgewater. You're just trying to create an avatar profile of that flow.
100%. I mean, that's modeling in general, right? Like, this is a unique data set, much like many other unique data sets. I think the big differentiator is it's a massive one, and it's growing and tremendously in size, as people understand, and it has a structural, regular structural effect on markets. So, I mean, the better you understand this, that the potential value of it is so much more than most any other data sets out there. And it's amazing how few people truly understand how essential this is and how important it is to the functioning markets.
How do you think your experience as a market maker, how general or how unique was it? So is it an advantage or a disadvantage that you've built up a gut feel of like, if I was a dealer, this is how I'd be positioned in this environment? And then broadly applying that to all dealers, is that accurate, or does that sometimes lead you to the wrong conclusions?
I think it's the right conclusion. I mean, obviously, it's a huge advantage in my view. Obviously, it's given me a completely different perspective than your average person. I'm not the only person who had that experience, but I think the difference is we managed such a big book for so long that we were, this came out of necessity, just like all the best kind of inventions do. It was, a result of putting on things relative to our surfaces that look like tremendous trades, right? And regularly seeing them not be profitable. And so, the more we had through a 13% of volume, we had what every other market maker had on. So, understanding how that chase and that competitive, trying to get ahead of the other people who had the same position and get out, ahead of them and monetize it, that effect, seeing that in real time, really gives you a feel for what would happen. And then eventually, with all the improved, you asked how things changed as well. I mean, 22 years ago, we didn't really have machine learning, right? We didn't have a lot of the statistical tools that we use. So now we have these tremendous tools that we can now, given the qualitative insights that we have, can really go hunt out like the optimal kind of, modeling of each one of these factors that we're looking at. So I kind of danced around, obviously it's a great value, but it's not the whole thing. I think if you start with this, a lot of great data sets, people use great data sets and then data mine them, right? And then just kind of, learning to find that hasn't been our approach. It's been always, understanding what's going on, making sure that we're focusing on the things that we know are structurally there, that they're not, we understand the causality, not just the correlation, right? I think that's critical, especially in a world where things are quickly changing and a lot of quantitative strategies, aren't performing as well as they used to because of that. People don't understand the causality. They're just playing correlation, and those things are fleeting. But, starting with that causality, that understanding qualitatively, and then using the tools to kind of better optimize, create statistical models, I think has really been a huge advantage for us.
Do you think I wonder, it makes me think, do you think there's a lack of people in your seat because there's very few people that go from market making, from clipping that coupon, no bad days, to then want to be a long vol trader where it's like all bad days?
Yeah, there aren't many people, like you said earlier, like that are a glutton for punishment, as much as I am, I guess. No, I think again, now I've had we're going on almost 9 years, 10 years of experience as a fund manager too, and it's really helped me tune into kind of some of the macro that I've always really enjoyed, but really kind of understanding the bigger picture stuff and understanding when things are turning to better understand these distributions. And so, also putting out products out there that institutions and people will benefit from, on a broader level, as opposed to just kind of trading for profit, not really, understanding or worrying as much about kind of the drawdowns or whatever. So I think I have a really unique, I agree, like combination of those two things at this point, and I do think it's a huge advantage for not just modeling the market, but structuring portfolios and strategies that are good for kind of the broad world.
So when we talked previously in this discussion, you talked about, using that 30-day skew and trading around that. But then you hinted at sometimes longer dated. And I think this is really interesting, is that a lot of people think about long volatility as long gamma, and therefore in a very acute sharp sell-off, that's where you make money. And in a prolonged recession like 2008, like a GFC, maybe long volatility tail risk is not going to do as good, but like commodity trend would really pick up that move, or some form of trend following would pick up that move. But you hinted at as soon as maybe as you start going out longer dated, and if that curve is in backwardation in a prolonged recession, you could be riding up that curve. And that may apply, I think we've talked privately about this. This may apply to inflation as well. So can you talk about like how you'd move to longer dated, and if the curve's in backwardation, how that leads to maybe a more positive carry during a recessionary environment or an inflationary environment?
Yeah, absolutely. I mean, this is all modeled within our tool itself, right? The opportunity set looks at, it looks at the opportunity set at any given time and structures the portfolio accordingly. That said, like the optimal kind of short tends to be like 2 standard deviations of the occurrences, 2 weeks to 6 weeks out, and that's kind of where the short the portfolio tends to be. That said, we go from being kind of more structured as balanced with more gamma in front of it and some vol behind it to really having much more, when it's in backwardation, longer dated exposure. Structurally, that's what tends to happen when that curve is in backwardation, and that that type of positioning allows a 2008 to be a situation where you're riding up the curve, like you said, and really monetizing, benefiting from more of a secular move and markets to the downside, and a more kind of secular move and higher vol, longer dated. So it allows the rebalancing to happen. So ultimately, a lot of our tools and modeling does this for us. So it's not just a discretionary kind of view when the opportunity set is particularly great there, and people are buying short dated because they don't want to go, vol's at 40, and they're not willing to go buy back the thing they were short from a 20 vol at 40. They'd rather cover it with a band-aid, hoping that you'll get the reflexive bounce back. You can really ride that 40 vol to a 50 vol and monetize the 80 vol in front of it over and over again as the vol goes higher. And this can be, you can kind of win on both sides of that trade for an extended period of time, as we did in 08, as we would have done in 2000 through 2003 as well. So so different, the portfolio does kind of naturally turn as the surface changes, as the opportunity set changes. Again, that allows us to kind of both have the tail when in the portfolio for when vols are lower and there's more likelihood of more of a convex initial move, and then eventually it'll naturally, when the curve goes into backwardation, move to a more kind of structured, longer vega downside structure.
And we can model it, but it's more of hunches because nobody's really traded it, because nobody's been around that long. But what if we had like a sustained sort of inflationary environment or a stagflation? Do you think you see more of that backwardation and you can go longer dated and ride up that curve, or how do you think about it?
Yeah, so an inflationary environment actually, interestingly, higher rates should mean more of a trending market, more autocorrelation. So that also, makes, if you have an environment where interest rates are going higher, vol is going higher, and a decline into it, which we haven't really seen, right, in recent history, is, I think that's a perfect environment for kind of this type of a structure, because you're going to see vol heading higher in a more kind of trending down market, which we haven't seen in a while, right? We've had incredible mean reversion in the markets because of really low interest rates. So, this is a strategy that particularly performs well in that environment. On top of that, there's an added inflationary hedge underneath the strategy, because of the margin for the strategy is only eats up maybe 20 to 30%. And on the actual cash position gets put into boxes on a regular basis. And so there's also, as interest rates go higher, there's an extra yield, because that cash underlying the strategy will actually be reinvested at higher and higher rates as time goes on as well. So there's actually an added inflationary hedge in here as well. I'll add, just as a kind of a side note, as to this is not what most vol managers are, kind of focused on, but there's a tax advantage side of this as well. It's all, index and future options. So, you also get mixed straddle or 1256 treatment, which is actually a huge advantage, obviously, as well.
Preach. You're preaching to the choir on that one.
Totally.
gotta love capital efficiency and a tax advantage contract. Exactly. So, we hinted at, your previous as, sitting on a desk to a market maker to, running volatility arbitrage at Aegea. But now, like you said, you're changing your name to KAI, K-A-I, Volatility Advisors. And part of that you alluded to is that you're adding new products. But what are some of the other new products you're adding, and how do you think about looking at applying your modeling to the global macro environment moving forward?
Yeah, our legacy funds have always been on the equity side. That's where the broad appeal was. For margin efficiency against equities, that was a more logical fit for our customers in our early history. But there's a lot of efficiency to be gained, from trading more on the future side. So also as we built out this, the more kind of directional trading component, which really was, as a simple, more focused vol arb shop, we weren't as focused on prior. There's a lot more futures trading, both in terms of correlation and dispersion and whatnot, that we'll be doing with the new products. So that's really made us want to shift to kind of a more kind of NFA, FINRA focused, firm, and I think we're moving more in that direction. That's what's necessitated kind of the new entity for us. Really wanting to kind of focus more on some of these really valuable directional indicators that we've been using, within these vol arb strategies for some time, and building out that have really become, kind of best in class, I think. That's really what's driven that kind of shift. Kai is my son's name, by the way. My daughter's initials are IAK, so she kind of gets the reverse, and that's, there's nothing. My wife is very. She's a big believer in that. That if you have the name of your children in it, you're going to work that much harder, right? So it's I figure you can't not have a great product when your children are involved.
Yeah, but then keeping the peace in the household. If you name it after your son, then you slide in the initials work too.
That was key, right? We never could have done it if that wasn't the case. But yeah.
And then, kind of outside the box question, I kind of want to timestamp this. This is February 22nd, 2021, just in case people are listening to this way in the future or whatever. And I'm sure I'm going to mischaracterize this, so I want you to be able to clarify for me. But you and I had a private conversation that I found very interesting a few weeks ago, and we were talking about just like a S&P 500 index, and how obviously over the last years people see this as a momentum trade or a growth trade, right? You do the index weighting and even float weighting. You're seeing used to be the Nifty 50, probably now like the Nifty 5 or 10, right, or Nifty 15, and you're riding that growth. But if we were to have some sort of real economic shock or drawdown or phase shift lower, and value came back as a factor strategy, that would actually rise to be represented in the S&P 500 index. And I thought that was an obvious but interesting thought point, that as a S&P 500 index investor, you're essentially riding what's ever in vogue or in fashion, whether that is growth or value. But you might have to go through a violent phase shift to be able to track that fashionable movement, which obviously volatility tail risk can help you in that sense. But I was curious about, that was an interesting way of looking at the S&P 500 index.
Yeah, so this kind of came about, I talked to Mike Green, who's big on passive investing quite a bit on these things. And he was very adamant for a long time that, hey, look, passive's going to keep growth, continuing along this path for a long time. And about 6 months ago, I was very focused on, how this rotation was coming. We called this, actually, fortunate enough to call this very early. And, my whole point to him was, if you get a situation where value does start to, whether it's through active managers or, just via the duration trade, if it's able to kind of get past this hurdle, at some point, passive is really a momentum trade. It's not a growth trade. And both people automatically tie those two things together. But the reality is momentum is not growth. You can have value outperform for significant period of times and be the thing with the most momentum. So if value can take the mantle of momentum, which it's slowly doing here, and if it can do that over a year or 2 years through products like the S&P and other passive Vanguard type products, it can become the thing that ultimately creates its own momentum and has a self-fulfilling kind of move back to kind of its place of a more balanced kind of S&P. So to your point, one of the great things about being hedged in the S&P and in the product, you're really hedging the changing face of the market at all times.
Did I mischaracterize it that it would take a violent sell-off? Do you think it can be a benign rotation to value?
It's hard to get all the way there without, I think, a more, I don't know if it has to be violent per se, but at least a more secular sell-off. And I think that's just because, it's going to take active managers, right, or corporations themselves buying back those value stocks for the momentum names, sort of the growth names, to really underperform relative as well, in a meaningful way. And so I don't think active has the the volume and stature that it had relative to passive at this point to do it on its own. And that's kind of why a market sell-off or something along those lines would really help to really reiterate the relative momentum of value over growth and get it to that point where passive then can carry the torch from there.
And speaking of passive, as Mike alluded to, that especially around the March 2020 sell-off, you still had passive buying into that, and that could be part of that V-shaped or K-shaped recovery, whatever anybody wants to call it. But actually brought it up with a piece that Corey Hofstein and I did the other day, that you were beating the drum that it's actually a lot of that dealer positioning on quarterly options expiration, especially triple or quadruple witching, and it actually coincided, really well with the passive inflows in that third week of March. And we saw it also in the previous, December timeframe. But as I brought up with Corey, we only have a few data points. So it's more of a hunch at this point, or how do you look at it as like the combination of quarterly options expiration and passive inflows, or do you think it's primarily on the dealer positioning going into quarterly option, OpEx, or is that a way to pin it, or also to cascade events, or how do you look? And it depends on the positioning each time.
Yeah, two different things.
5 questions. That's like 5 questions.
Yeah, two different. No. My view is look, you have dealer positioning and the flows that come from that, right? And then you have passive and the flows that come from that, and they're different things. And they both have dramatic effects. They're all part of the the equation, the supply and demand equation. And we really don't look at fundamentals, broadly, other than when I say fundamentals, like macro flows. Some people call those fundamentals. Those are flows. For me, it's all about flow. And growing up as a market maker, right, in the business, that's what matters. It's where the price clears for things. And so you have different structural flows. You have the passive versus active, which is very important, kind of much slower kind of turning and kind of just does its thing over periods, right? There are rebalancing periods where it'll change a little bit or whatnot. But the thing about risk premia hedging, or and particularly as it relates to options, hedging, is those work on very kind of structured calendar intervals, and they're much more they're very significant in terms of size, but their change is significant. How much the change in those flows is really dramatic over different periods. So really understanding when that positioning changes is much more powerful in terms of prediction, I think. Over kind of shorter periods, prediction. They're more kind of quick twitch kind of flows that change quicker, whereas passive is a kind of a lumbering, slow, constant, thing that's happening underneath the market. So when we're talking about what happened with quarterly in March and how we saw it in DC, I also, in September we saw it of last year. That was actually a big period where we saw rotation begin and kind of that initial decline. That was also something that we were able to call based on these flows. And it's really quarterly matters. It could happen at other big monthlies with the open interest is big enough, but there tends to be, at quarterly expirations, particularly, the expirations that have been on the books for quite a bit longer, bigger positioning and bigger effects.
Can you kind of explain how, going into that quarterly expiration, how, you have all of those dealers hedging leading into expiration, but then expiration rolls off those contracts and it clears the market for allow to a bounce back? Maybe that's counterintuitive for some people. Yeah.
So, walk through March, the positioning in March was short enough that, on the downside, that and a lot of people were hedged with kind of February options in front of them. So as February kind of rolled off, or and people didn't, like, we could see that people weren't re-hedging enough relative. It opened up a situation where dealers were caught flat-footed and really short. So that when other factors came into the picture, the way we see it is as that February was expiring, right? All the, that exposure was expiring. That was causing Vanna flows, positive, pushing the market up to kind of an unreasonable height, right? And there's kind of a natural, when that Vanna and Charm disappears, there's a natural give back. Now, that give back may just be something where it creates a correction in time or a digesting and people get rebalanced if the positioning isn't too big. But if that has gone too far and there are other factors and other rebalancing things that come into the picture, and that tail is really not hedged and particularly big following that can lead to, particularly with the right, with the news that we had, right, with COVID and whatnot, it can allow for an opportunity for things to really kind of steamroll. And when that happens, now you have a situation where everybody's trying to get out of the door this big, with leveraged positions at the same time. And most of those positions were in March. So, there was a big buyer in VIX calls. A lot of people call him 50 Cent or whatever, right? Like he was one of the drivers. There are a lot of other kind of short positions from firms that we know that are no longer with us, that kind of led to kind of a steamrolling effect where everybody was trying to chase the same positions at the same time, and that forces the market lower. We've seen this again, XIV in 2018, August 2015, when you want devaluation, when that positioning is like that, it can be the driver. It becomes the driver. It's that reflexivity is actually way more powerful than the fundamental underlying factors that other people may think are driving the boat.
And then, not to overly simplify, so it exacerbates the move, but then once those contracts expire, they no longer have to hedge those moves, and they're not accelerating those moves. So it's just like the air pop can collapse and just allows it to go the other way.
Yeah. Not only that, if you think about it, right, if something is really crazy high because everybody's shorted, everybody's trying to get it back, the March is here, right, and things behind it are here. What are people going to go do? They're going to go buy what's cheaper to try and hedge what's going crazy. They're not going to try and just buy the thing that's going nuts. So the positioning got to a place at the bottom where people were longer dated Vega against kind of this March that was on the way out. And so the second this March expired, it looked like, again, a great trade. Everybody's like, well, this stuff's expiring. I own this stuff really cheap relative. Well, guess what? Now everybody went from being really short gamma and really short protection to decaying longer and longer vol and shorter delta and longer skew. And so what had happened? Skew collapsed, vol collapsed. The market started the Vanna and Charm flows started to kick in, where all that vol compression is leading to more buyback of deltas, and we were off to the races. And so it's not just that the shorts expired; it's the positioning that came about because of that demand on those things leads to a reflexive move the opposite direction.
Exactly. And this is going to kill me because we try to be fairly evergreen on our content. So I can't help the topical nature of this, but it relates to what you're saying. So hopefully I'm curious of your take on the GameStop, scenario, and because it's related to what we just talked about as far as where the positioning are, where the hedges, and then, eventually things collapse when people no longer have to hedge their position. And I'm kidding. There's probably, you've probably thought about it 10 different ways. So I'm going to give you the floor to pick and choose your spots and tap dance through that.
Yeah, gamma's that's a gamma story, right? That's almost like way simpler than a lot of the other things I talk about, because it's, you have these Vanna and Charm flows and everything, right? But this was so focused on upside calls and against, stocks that where the float was really low, and it became a squeeze, just like we saw in March on the downside, right? This is the same thing, but on calls and single list on the upside, and that kind of an identical scenario, right? And put it in reverse, what are people doing who are short? They're not going to go buy back that kind of short dated thing. They're going to go buy something behind it. Eventually, we saw this with Tesla very recently. I was able to kind of call essentially the top here, right now for the short period in Tesla, because essentially all those calls that have been bought, dealers are short them and they're long stock. So the second the momentum slows, right? It doesn't take a reversal; it just takes a slowing. All of that decay, right, of those, that call premium means all these dealers now have to go sell all their stock that they've been writing up against them. And so eventually that leads to selling, that it creates even more of a lack of momentum. It becomes kind of a self-fulfilling prophecy. And then eventually, it can lead to an unwind. And it's usually not the thing, there's usually has to be something else to set it off, right? Kind of, like we saw in this case, it was, Robinhood and these other entities, having margin calls and not being able to allow that same level of flow to continue. But once that happens, much like with passive and these other factors, they're kind of momentum driving factors, right? That a second something stops, it naturally there are flows that are technical that essentially force it kind of the opposite way. And so understanding how those dynamics work is really important. And a lot of people have modeled these things with technical analysis and again, correlation, right? Things that, they understand, well, when the momentum slows, then I want to be X, Y, and Z. The problem there is it's correlation, not causation. Understanding how these things work and modeling based on understanding the underlying dynamics is much more powerful and much more, is a strategy that will last for history, as opposed to kind of a lot of these other quantitative strategies which don't work as well.
Was it making you want to rip your hair out when people were talking about payment for order flow and the evil market makers and with lack of nuance, or what was your thoughts?
Well, yeah, I mean, look, running a market making firm, kind of, I understand kind of the positions that, a Citadel or whatnot, are in that scenario. This is for people who have traded these markets as actively as we have. You understand it's an extent, it's a war, it's self-preservation, right? So these guys are getting massive flows in a direction. What are they going to do? This is not a sympathy thing that they're going to profit from it. They're going to try and protect themselves and get ahead of it. They're not only going to raise the implied volatility as much as they can. They're going to own whatever flow is coming, proactively to try and know if somebody's going to come buy something from you constantly every day. You better own it and so you can sell it to them. Otherwise, you're going to get short a lot of it. So. There's a lot of analysis and a lot of finger pointing, but the reality is, they, as market makers and dealers, are providing liquidity in the marketplace. And the best way to do that is to actually take, the same direction side as all the flow is coming and ride the flows. I mean, in a sense, we're riding flows too. We're sitting here looking at where the flows are coming from and what that's going to mean for the market and changing our distributions, as we talked about, accordingly. And that's what any, honestly, good trader who's been in these markets long enough understands and needs to understand to be profitable.
I always save my hardest question for last, and obviously we're riding the fashionability of long volatility. It always, after a sell-off, all of a sudden everybody wants to talk to the long vol guys and talk about the higher order Greeks, which I'm sure you're surprised by. So if I was smart, I would have bought call options on your Twitter account a year ago. And so I'm curious at the end of the day how you see the Thunderdome of Twitter as a long vol or short vol, or do you think you've figured out a statistical arb with long wings?
Oh man! For followers, or are you talking about
in general? Like, how do you manage Twitter? Like, you seem to navigate it well, and so that's what I'm saying. You're riding that wave, and maybe capturing the upside and trying to. Do you use your mute button fluently, or how do you think about it?
Yeah, look. The beauty of social media is if you have. The best ideas kind of rise to the top, and this is something that people don't understand. I'd love to say I have some magic, model that allows us to kind of to grow our Twitter accounts and our exposure. But the reality is, these ideas are things that we've developed in house. This is not in a book. This comes from experience. We're writing white papers as we speak, right? But we're really getting the word out there on something that's very powerful, and I think people are seeing the benefits of it. And the value, the convexity of a powerful idea is tremendous. Never short a powerful idea. So we're long ideas.
I like that. You can find Cem on Twitter at @jam_croissant. But thank you so much for being on. We appreciate it and look forward to our future endeavors and conversations.
My pleasure. Thanks, Jason.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, Thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.